to another edition of Taking Stock, your weekly dose of all the market action and of course all the cues that you need to watch out for as we head into trade this week. I'm Sonia, Shenoy, and with me as always is Anuj, Singhal. What a week it was for the market. So when we started off, we had that big crash on Monday with the Sensex down more than 1,500 points, and at that point there was so many doomsday scenarios that were being talked about. But finally, Anuj, by the end of the week, there was some respite to the market. Of course, it was a tough fight between the bulls and the bears. But at the end of the week, you still get a sense that the bears are not done with their ammunition just yet.
Yes, Sonia, I think you hit the nail on the head. Towards the end, the bulls did show a bit of a fight. But it looked like, the bears thought, okay, let me have some rest and then, I'll attack later. But
the punch from the bulls was weak.
Yes, it was. And I think the bears still had the better of the week. The decline may well have altered the market's psyche, in terms of this market being a buy on dips market. This could have well changed to a sell on rally market in the near term. The risk remains that the Thursday and Friday rally was a suckers rally, and normally suckers rally are quite powerful. They normally last for a week or so. So it will be interesting to see if over the next week we also see continuation of this rally that we've seen for the last couple of days. But this week was telling you that nothing was spared. The Sensex and the Nifty were down 3.5%. The Bank Nifty was down. Sonia, even the Pharma Index was down about 4%. Some of the pharma names corrected quite a bit. The IT Index was down 3.7%. So that was telling you that this was a secular decline in the market, and I think next week I'll be watching out for the last week's low, both for our markets and US markets. Too many variables right now, and I think the strategy could be to just stay on the sidelines and maybe come back once the market sees some kind of stability.
Yes, indeed. You don't always have to trade, right? So in a market as volatile as this, perhaps the best thing to do would be to stay with cash. But is that the view of our guests? Let's get two guests now to speak with us. Joining us now is Bala of 1857 Advisors and Sanjay Dutt of Quantum Securities. So let's get both of them into this conversation. Sanjay, hi. Good. Thanks for joining us on the show. It's very interesting what happened last week. We had a big fall on Monday, but then we saw a bit of recovery towards the end of the week. What's the sense you're getting? Is this the time to be going out there and filling your shopping baskets, or it would just make sense to sit out and wait for this volatility to settle?
I think the fundamental point that we need to get clear here is that we are in a structural bull market, and what we've seen is an extremely aggressive correction in that structural book market. And we must realize that whenever such deep aggressive corrections occur, the bottoming out is basically a process. It's very rarely a sharp, weak kind of a recovery. So therefore, I think it's going to take a little bit of time for prices to consolidate, prices to remain plus minus at the current levels. Maybe we've seen the price correction, we may not have seen the time correction. So we may spend a little time here, a few weeks or few months at round about these levels or a little higher than these levels. But fundamentally and structurally, I have no doubt about the fact that this is a good time to buy into select stocks which you missed out earlier, and also look at new opportunities wherever you think valuations are turning compelling and investment horizon is 2 to 3 years ahead. You are definitely going to make money. I have no doubt about that.
Sanjay, hi. So can you say with conviction, like you told us last time, that 7,900, give or take 100 or 200 points, of course you can't time the exact bottom, but that should be the bottom, and in terms of price damage, we should not go back to say levels like 7,000 or so. I mean, because that's a bit of a risk with the kind of global cues that we have seen. That is there a bit of a meltdown around the corner? You don't think something like that could happen?
Anuj, I don't think so, and I want to look at it very clinically and not emotionally or because something is sacrosanct about a level. If you just break up the index and you look at the components in terms of banking, oil and gas, IT, pharma, and if you were to analyze the weightages, there is a very little chance that, if you're very bearish also on India, would you go to a level below 7,700 if you looked at all the stocks, whether you look at the banking sector, which has seen the worst, if you factor in the worst levels of the banking stocks, and similarly you factor in the worst levels for the oil and gas stocks, given the fact that some of the oil refining company margins might be under challenge, etc., etc. But then at the same time realize that, rupee is up, pharma is giving you support. When rupee is down, so therefore technology stocks will give you support. So I basically come to a level, what you correctly said, that plus minus 100 points. I think that should be a firm base for the market. What we saw in this week, probably, those lows, I don't think those lows will be tested again in the near future, unless obviously some new kind of development comes in. I don't see any other reason that, the low will be tested or will sustain for a long period of time, and we would be, going to months of a sub 7,500, sub 7,600 kind of a trading range.
Okay.
I have my doubts.
Okay, that point is taken. Let's get Jay Bala also in this conversation. Jay, hi, good to have you on the show. Now, were you surprised by the meltdown before the expiry? Because, your view was that the market would see a short covering bounce towards 8,500. Of course, not holding you to that for that. But, going forward, do you get a sense that because the market did not see that kind of bounce, there's a risk of this market actually now seeing a bit of a breakdown, maybe towards 7,500?
I know. You need to hold me to it. That's what price action is all about. We have to accept that several points that we are wrong on the markets. The markets are always right. So I know if you recall, I was saying in February, the markets were bound for a 10% correction, and I'd asked investors to raise cash. So our view at that point was that this correction from 9110 was a 10% correction and a correction of a smaller degree. But by going longer than 2 months that I had projected in March and breaking below the 7940 mark, what the market is telling us at this point of time is that the correction is of 1 degree larger than what we had assumed. So what that means in terms of price at this point is that the low that we saw last week, that at least needs to be tested. If my interpretation is correct, the market needs to go slightly below that. 7590 on the Nifty is a very important level for me. I think if the market were to go back and test at least 7767, that the low it made last week, or go slightly below that, that will make a lot of sense. That's what will make a durable base. I agree with Sanjay when he said bottoming out is always a process. Yes, it is a process, but I beg to differ slightly in the way that all lows need to be tested for it to become durable. Otherwise, the market is standing on 3 legs. So, that's never stable. So, we want the market to go back to the low and retest it. And even if you look at the global markets, the price structure is very similar to what it is in the rest of the world. But the damage in the European markets, it's much more severe. So, I think we need one more revisit of the low. And then if that were to hold, or if the market were to go slightly below it, that will make the correction complete. We give more importance to form over price ratios. So we want the form to get completed. I think that will get completed once the market goes slightly below the low, not too much below the low.
All right, fair enough. Sanjay, just coming back to that point you were making about how this is a great opportunity to buy some of the stocks that you wanted to buy but were at high levels. I'm going to name 3 such stocks that have no fundamental problems but have been hit because of the crack in the market. There's IndusInd Bank that fell about 7%. There's Kotak Bank that fell about 7% this week. And there's Maruti Suzuki that fell about 10-odd%. Do these 3 make for good buying opportunities for the longer term?
Good question. Now, I actually wanted to touch upon this point. So therefore, let me address this question of yours a little more broader perspective so people get an idea without really passing a verdict on whether these stocks are going to fall more or whatever. The only negative that I see for India at this point of time, which actually is a big negative and we are seeing it playing out, is that out of the emerging markets, and in fact, why out of the emerging markets? Out of most markets in the world, FIIs and in fact international investors are kind of overweight or overexposed to India, in the sense everyone is optimistic about India. If you ask anyone amongst the EM baskets who's sitting outside India or is looking at India, he says India is different, he will look to buy India, or he already owns India. So these kind of stocks that you just mentioned actually are a victim of over ownership. They aren't victims of fundamental, what we've seen them in the last week, 10 days, the huge sell-off that we saw in most of these stocks. So therefore, my problem with these stocks is that anywhere where there is over-ownership, particularly at the FII level and the institutional level, I would be worried there, because that's more vulnerable. Because when a fund manager sitting abroad has to pair EM exposure, or he has to pair financials exposure across all markets, he doesn't look whether he has IndusInd Bank or he has ICICI Bank. He just goes across the board and sells, say, $200-300 million or $500 million of financials. So all these stocks are actually victims of that and not victims of really, fundamental changing overnight or have changed over the last 4-5 months.
Okay, so your point being that we should get into these stocks or avoid them?
No, I think whenever they fall and you get a panic bottom in them, you should add them, but don't be in a hurry to really stock up and complete your exposure, because once selling comes, then you don't know what really, irrespective of fundamentals, they may fall 20% or 30%, but that doesn't mean that the fundamentals of those stocks have changed.
Sure.
So I would say buy them, but be careful when you're buying them and buy them in small lots.
Okay, fair enough. We'll do one thing. We'll take a short break and we'll come back and continue our chat with the both of you. As we slip into a break, let's listen into some market opinion that we heard in what was one of the most volatile weeks we've seen in the recent past. We'll come back.
I think the emerging markets in general are still going to have a very tough time. And I would say you could see maybe another 10 to 15% fall in the emerging market as an overall category before things sort of bottom out.